this is the introduction to self-directed IRA and solo 401k. And our mission, I want to start out with that, is to help clients obtain control and protect their retirement accounts. You work really hard for your money and likely have for many years, and we want to come alongside you and work hard with you as well on your behalf. And Proverbs 21:5 says, good planning and hard work lead to prosperity. And so there's a couple of different types of retirement accounts, right? There's the conventional side, think stocks, bonds, mutual funds, and the conventional custodians, right? Vanguard, Schwab, T. Rowe Price, all of those that you've no doubt heard of. On the conventional side, offering what they offer: stocks, bonds, mutual funds, ETFs. And then on the self-directed side, I should go back to the conventional side. That's what we like to say is the bus, right? You have to be at the bus stop at a certain time, and it's going to pick you up. It's going to stay on the track it follows. It's also going to stop at certain stops, and then you have to not only walk to or get a ride to the bus stop to get on the bus, but you actually have to walk from the bus stop where it drops you off to your destination as well, or get picked up by somebody else. On the self-directed side, we have all of the alternative asset investing, right? Everything in addition to stocks, bonds, mutual funds, ETFs, et cetera. But there is a lot more, right? There's virtually no limit. We'll cover what the IRS says you cannot invest in, but on that side, you can invest in just about anything, okay? Most of our clients are looking to invest in real estate, but that's certainly not the exhaustive list that is available. And then on that side, you have the off-road vehicle that can go anywhere. Off-road, on the road, through water, through mud, and it has a higher profile, so it can go over rocks and logs, etc. Right? So you can go just about anywhere with the off-road vehicle. And again, virtually unlimited investment options. Cryptocurrency, Bitcoin, cryptocurrency, excuse me. You can become a private lender. You can invest in tax deeds. You can own residential real estate. You can own commercial real estate. You can loan to businesses to help them grow their business, kind of be an angel investor, if you will. Precious metals, of course, virtually no limit. And just a quick example of what an IRA makeover looked like for one of our actual clients, but could look like for you too. Jason from Florida, before he came to us, he had an IRA and a 401k valued at about $135,000. At the time, he was invested in the stock market. Excuse me. He was invested in the stock market, and he actually was losing money. This was a time where the stock market wasn't doing so well, and he was watching his account go down. So what he actually did, he actually pulled all the money out and was just holding it in cash, which is probably worse than buying it on sale, because at some point it's going to go up again. Nevertheless, he decided, I got to get out of this. So he found us. He opened up a checkbook control plan, which we'll talk about. And he actually bought a rental property. He invested in his brother's business, manufacturing business, and he originated a note, and he loaned to somebody who was going to own real estate, and he was the lender. He became the bank. And so he went from losing money to not doing anything because he pulled it all out of investments to making about $1,000 a month in pretty quick order. And so that's just an example of what can happen. Obviously, the numbers can be different, but that's an example. So there's a couple of products that we offer. One is the self-directed IRA, and the other one is a solo 401k. So on the self-directed IRA side, virtually anybody can qualify for a self-directed IRA. There's no requirements. On the other side, with the solo 401k, it's primarily for a business owner and their spouse, and no employees, which we'll talk about further. So those are the two products that we offer. But first off, what is a self-directed IRA? Well, it's a trust account. It's a tax-deferred trust account. It's held with an IRS-approved custodian. You have to have a custodian with an IRA. and it allows you to invest in non-traditional assets, which we covered briefly, and it's been around since 1974, so it's not new by any means. And why is it so little known? I don't know. Maybe those of you that are on this call, you've probably heard of it, but maybe not. I think sometimes tax not tax attorneys, but possibly tax attorneys, but mostly it's going to be financial planners and such may not either know about it or may not tell you about it because most of the time they're not necessarily going to be able to benefit personally from that. So it's not a service that a lot of them offer. And it's actually been benefiting Americans saving for retirement under Internal Revenue Code Section 408. Some of the other benefits of the self-directed IRA, again, non-traditional assets, you can truly diversify. The returns are tax deferred or no taxes down the road in a Roth. And there are no capital gains taxes on the sale of real estate. There are no taxes on real estate. It's great. And then you can leverage your funds if you want to buy a larger property. You can get a non-recourse loan with your retirement account. So here's how the self-directed IRA works in a diagram. First, a new IRS-approved custodian account is opened. Okay, so that's number one. Then you set up a qualified transfer from an IRA, an existing IRA at one of another firm, right? Another custodian, former employer 401k, a 403b. Pretty much any qualified retirement account will allow you can actually transfer over. So that is transferred to the custodian, and then you start to make investments. So the custodian holds all the money, the income and the expenses go through the custodian and stay with the custodian and their IRS approved custodian trust account that has your money. And for all the investments, you actually go through the custodian. All transactions go through the custodian, which if you're going to own real estate, as an example, can be not only a laborious process, but it can actually be quite expensive because depending on the fee structure of the custodian, you can have transaction fees each time you do a transaction, whether it's money coming in or money going out, right? And so that's a custodian, full custodian self-directed IRA. So some of the disadvantages, which I sort of covered already, there can be some red tape to get through because you do have to go through the custodian. They have to actually, write out, they have to fill out the paperwork, whatever it is you're purchasing. So if you're investing in this syndication, that paperwork they are going to complete, right? If you're buying a property, the purchase agreement and all subsequent agreements and everything along that process from start to close is going to be done by the custodian. So it can cause delays. There's definitely a lack of control. Custodians are human, it's a human being doing that. So there can be mistakes that are made. And then the, again, fees for sometimes issuing a check, purchase and sale, transaction fees. Sometimes there's asset-based fees as well. So just be aware of that. We don't offer custodial IRAs, but I want to make sure that we cover the difference between that and what we do offer, which is called the Checkbook IRA, which we feel is superior for a lot of reasons that we'll cover. One is it's also known as the IRA LLC. So what it is, a special purpose LLC is created to be owned by an IRA, and this requires an IRS compliant setup and operating agreement, which we put together for you. And this actually allows you, again, you can't eliminate the custodian, but this allows you to bypass the custodian when you're making investments and transactions. So here's how it works with a quick diagram. Again, same thing here. Open a new account with the IRS approved custodian, set up the qualified transfer. The money will go from the current custodian to the new custodian for the self-directed account. And then in the middle of that process, the LLC is created, right? Again, special purpose, special language designed to be owned by the IRA, single member. IRA is the only member. You're the manager of the LLC, which gives you what's called checkbook control, allows you to then open up a bank account, a regular checking account in the name of the LLC. And this allows you to buy, the IRA buys 100% of the units of that LLC. So again, the IRA owns the LLC. And by the way, I didn't say this at the beginning, but please type any questions you have, comments, whatever. I will provide time at the end to answer and address any of those. So please don't hesitate to put some questions in the chat. And any investments you do go into and out of, so at the end of those 4 steps, you'll be able to self-direct into whatever asset class you would like, right? So any investments you make, the income from those investments and the expenses required to make those investments or keep those investments will go into and out of that same checking account. Very important that there's no commingling of funds at all. And then some more advantages of the Checkbook IRA. Well, again, you get to bypass the custodian. You get direct access to your money. It's faster. How fast is it? Well, as long as it takes you to write a check or do a wire transfer from your checking account to wherever and make that investment, right? So it's pretty quick. And then you do with the LLC, it's limited liability, right? So you have some added protection from litigation. Of course, we're not asset protection attorneys, so this is just information, but we do encourage you to check into getting, in addition to an LLC in this situation, possibly getting an umbrella policy on top of, if you hold real estate, on top of, your regular hazard insurance. And then another advantage is the low fixed custodial fees. And unlike the full custodial self-directed IRA, where the asset, real estate as an example, title is held in the name of the custodian, with the IRA LLC, the asset is held in the name of the LLC. So with the custodian, it's the custodian for benefit of, and then your retirement account, your IRA. In this case, it's just done in the name of the LLC, and you sign on behalf of the LLC. So now we're going to transition to a solo 401k. So this is actually under subsection K, retirement savings. Again, it's designed for the self-employed or small business owners, hence the word solo. It is not new. It's a simple 401k plan covering their owner and their spouse, and actually came around in 2002. And so that law change made many of the current benefits of the solo 401k possible. So real quick, I want to cover the eligibility for a solo 401k. If you're listening to this, you may not be self-employed. Maybe you're W-2 and you work Monday through Friday. Well, don't go anywhere, because I think you're going to be intrigued by the offerings and the benefits of the solo 401k that are, in my opinion, superior to the self-directed IRA. This isn't to knock self-directed IRAs. We offer them, but the solo 401k just has some benefits the IRA doesn't. However, it does come with the self-employment requirement, legitimate self-employment activity. So don't go anywhere. You may be self-employed down the road, and really it's not hard to become self-employed. And so some examples are, and by the way, this can't be a hobby. So this actually, you're in business to make some money, right? We have doctor clients, we have attorneys, property managers. In fact, I'll camp out on that one for a second. Many of our prospective clients come to us and they have rental properties, right? And so sometimes they've exhausted their personal funds and don't, maybe they can't qualify for another loan and they don't have enough money for the down or to buy in cash or whatever the case may be. So they own some rental properties personally and they want more. And so they learn about the self-directed IRA and the solo 401k option. And so they say, okay, well, I want to buy more real estate. And they find out about the solo 401k and they're like, man, I wish I was self-employed because I'm living off my investment income from my rental properties. However, that's passive income. That's Schedule E income. That is not going to qualify you for self-employment. Well, what does qualify you for legitimate self-employment activity in that situation is if you're already managing the properties, just form a simple property management company, and now you are self-employed. So you manage those properties, take, 10% as an example of the gross monthly rent, pay yourself through the property management company, and now voila, you're self-employed. You can qualify for a solo 401k, and you didn't have to do anything you weren't already doing. If you do have a property manager in place, well, you could consider, letting them go and doing the management yourself. That's up to you. Happy to discuss that and anything else in more detail if you want to set up a call, by the way, which we'll talk about how to do at the end. So I just wanted to camp out on that for 1 second because a lot of our clients kind of fit that category of, I want to do the solo 401k, but I own rental property already in my personal name, but I'm not self-employed. So that is a solution. And then you can do network marketing, consulting. You can, we have nurse clients. Every one of these categories we have a client of at least, more than one in most cases. You can fix and flip real estate, wholesale, day trader in some cases, and then any sort of 1099 income is going to qualify you, right? So think, the gig economy is great, right? You can go drive for Uber once a month on a Saturday and be self-employed. You can do DoorDash, whatever it is, right? Any income that's reported on the Schedule C is going to qualify you. And then the other requirement is the absence of full-time employees, so less than 500 hours per year for W-2 employees, which we're going to talk about. So leased employees are not allowed. Okay, that's the temp agency type employees. Independent contractors are perfectly fine. 1099, you're issuing to them, that's fine. Anybody excluded from this requirement are under 21 years of age and working less than 500 hours annually. And if you do hire somebody who, if you have a solo 401k and you do hire somebody, you actually have a year, even if they're working more than 500 hours, you have a year to kind of get them under that 500 hours, let them go, turn them into 1099, whatever the case may be. So it actually doesn't kick in for the first year of employment for that person. But nevertheless, it's easiest just to say no W-2 employees other than you and a spouse. Here's how it works. So you have the plan sponsor. That's the legitimate self-employment activity, right? It can be sole proprietor, corporation, LLC, S corp, partnership, whatever, doesn't matter. So that sponsor sponsors and adopts the plan for the 401k, and then the plan and the trust is created. Okay, so a trust instead of an LLC for the IRA, and then the solo 401k trust actually holds the assets of the plan. You are the plan trustee. Okay, so there's no custodian in this situation. Again, you can have full custodial or custodial solo 401ks where you're the same thing with the self-directed IRA. You're going through the custodian and you are, they're on title, they're doing everything, they're making the transactions happen that you tell them to do, all that good stuff. But with this case, just like the Checkbook IRA, the Checkbook Solo 401k, you are the trustee of the trust that is owned by the Solo 401k that gives you checkbook control. And so as the trustee of that trust owned by the 401k, you can open up a bank account, really a checking account, which is kind of going to be the home for the money until you deploy it into investments. And then actually you can open up any bank account or brokerage account at any financial institution in the name of the 401k trust. And then all income and expenses, just like the self-directed IRA, must go into and out of that bank account, whether it's real estate, you're a lender, precious metals, cryptocurrency, just as some examples. It doesn't matter. No commingling of funds with your personal situation. This is a different entity from you. All the income and expenses have to stay separate from you. The other benefit is high contributions. So we didn't cover this, but the IRA contributions are $7,000 annually or $8,000 if you're over 50. Well, the 401k has over $75,000 per year per participant. Okay. Now that number actually is $76,500 if you're over 50 and over. If you are under 50, it's $69,000. Okay. And this consists of two parts, which we'll break down: the employee and the employer. Proverbs 21:20 says, "The wise man saves for the future, but the foolish man spends whatever he gets." If I could just bestow that to my children at a young age. Some more benefits of the solo 401k are, again, we talked about the high contribution limit. We didn't talk about the participant loan, but we will, which you can actually use for what would otherwise be prohibited. So if you have a 401k at a W-2 employer, you have in the past, you also have access to this participant loan. In the situation of the solo 401k, it's up to $50,000 or 50% of the total plan assets, whichever is less. And you pay that back over a period of 5 years or an amortization period of 5 years, no prepayment penalty, at an interest rate of prime plus 1%, or over 15-year amortization if you use it for a personal residence purchase. So we'll talk about disqualified parties and prohibited transactions, but just know that this participant loan can be used for, that's personal money. Once you take that loan, you can use it for anything. And then the 401k also has a built-in Roth, right? A Roth component, the Roth sub account, we call it. and it's in the same plan, right? And so you can do a Roth conversion as well. You can take IRA money and you can create a solo 401k, transfer that IRA money into the solo 401k. This is traditional pre-tax money, right? Then within that solo 401k, you actually can do the Roth conversion. So you take that pre-tax money, whatever dollar amount you want, check with your CPA for the tax consequences. Then you can actually take, let's call it $100,000, convert that to Roth. Now you're paying taxes on it today, but you invest it. You're going to pay taxes on the seed versus the harvest because you're going to take that 100,000, you're going to buy a rental property or whatever you're going to do, and you're going to grow it tax-free forever, right? So when you withdraw the money, then there's no taxes on it. Unlike the pre-tax where it grows tax-free and then you pay taxes on the harvest down the road, right? When you take out your RMDs or withdraw money from it. So the Roth is in my opinion the best way to invest in real estate. With your self-directed retirement account. It is this plan, the Solo 401k, is cost effective. It's easy to maintain. So let's break down the contribution limits. So you have the employee side and you have the employer side. On the employee side, you can go up to $23,000 per year. Okay, this is the same as the W-2 401k, plus that additional $7,500 catch-up. You can contribute if you're over 50. You can contribute up to 100% of your self-employment earnings. So if you have a W-2 job where you're making money and you, let's say, just as an example, because it's easy for me, you get your real estate license and you're going to do a couple transactions a year, maybe just referral deals that kind of fall in your lap, but you're in business to make money with your real estate license, but it's not your bread and butter, right? So a couple properties a year. You don't even have to do that, by the way, but just using that as an example. If you made 15,000 of commissions, you could put 100% of those earnings into the 401k and not pay any taxes on it. Again, you don't need that money to live on because you have your two job in that scenario that's paying your daily expenses to live. So that's an example of how you can contribute up to 100% of your self-employment earnings. Now, your contributions do need to be made within 7 days of paying yourself, and you can do, again, pre-tax or after-tax Roth. On the other side, the way you bridge the gap between 23,000 and 69,000 or 76,500 if you're over 50 is through the profit sharing, which is you can contribute up to 25% of your self-employed compensation, basically what you pay yourself for S Corp if you're incorporated, and then if you're sole proprietor, single member LLC, it's up to 20% of what you pay yourself. Okay, and then so that makes it so the total limit is 69,000 per year, and this is for 2024. Which, if the catch up, you're over 50, then 76,500. So pretty monumental compared to 7,000 or 8,000 if you're, for the IRA. So the Roth contributions are made from the employee side only. Okay, the employer contributions are a tax deduction for the business. Okay. On the employee side, that's where the Roth contributions must be made. So you can do the 23,000 plus the 7,500 catch up, and then versus the Roth IRA again, which is 7,000 or plus 1,000 if you're over 50. And again, with the Roth, all incomes and gains are tax free. The contributions you already paid taxes on, so you can actually get access to those at any time if you have an emergency or whatever. And then again, we talked about the Roth conversion, so you could do that within the Solo 401k as well. Checkbook control. So it works the same way as with the IRA, right? You eliminate the custodian, the delays, the red tape. You're the trustee. You can act quickly, and it is easy to operate. So there's a short form 5500 easy. It's 2 pages that you will fill out once you get to 250,000 plus of total plan assets at the end of a given year. And we encourage people to just fill it out, our clients to fill it out anyway and turn it in. It doesn't matter. It's not going to create, a taxable event, but the IRS does require it if you have over $250,000 of total plan assets. And so it's good to get in the habit of doing it, even if you're not at 250. Purchasing real estate. So real estate income and gains are generated by the account are tax deferred. You pay taxes at the future date rather than in the year the investment produces income. And of course, in the Roth 401k, all the income and gains are tax free. So think about this. It's pretty wild, right? Not only is the rental income tax free, but the appreciation, there's no capital gains on that. You can sell that property anytime. The money, of course, has to go back into the 401k and stay there as cash, or what you should do is deploy it into another investment. But there's no need for a 1031 or any hassles like that, because there's no taxes on it anyway. And so it's pretty amazing when you think about it. And then again, the income must go back into and out of the account, and expenses must be paid from the account. So if you're purchasing real estate, the purchase agreement must be in the name of the IRA, LLC, or the name of the Solo 401k trust. And then the earnest money deposit, everything's got to come into and go out of that same account owned by the retirement account, or rather owned by the LLC or the trust. You can use leverage if you want to buy more property than you can afford otherwise, but the loans must be non-recourse. Okay, the property is the only security. So because of that, they're going to require a little bit more down. It's closer to 40 to 50% right now. And I was actually talking to a lender yesterday, and this is a non-recourse lender, and it was, don't quote me on this, but it was like 9, and it depends on how much you put down and such, but it was roughly like 9-ish% with a 1.25% origination fee. And but again, that depended on what you put down. I think that was 45% or 40%. So just to give you an idea of what the interest rates might be, but they're not going to do the loan if there's no cash flow. So this is a way to make sure you're purchasing smart. If you use leverage, they're not going to do it if the cash flow is not going to be there. And of course, the lender is going to do their due diligence to make sure that what you're saying it's going to rent for, it's actually going to rent for. You do have to have some reserves. And with the IRA, this will trigger UDFI, unrelated debt finance income tax, which we'll talk about. And then that link right there, if you want to go to our website, you can check out a list of non-recourse lenders and give them a call and find out what their terms and what they offer are. So that's SenseFinancial.com /non-recourse-lenders. And then purchasing real estate. So that is a duplicate slide. My apologies. Exempt from UDFI tax. So I mentioned the UDFI with the IRA is a thing, right? Well, there is no UDFI within the Solo 401k. So in an IRA, that actually triggers what's called UBIT, or UBIT, unrelated business income tax. And those tax rates are approximately, they scale up to 37%. Okay, so this is a tax on the financed portion of the real estate on that income. So if it's 50% financed and 50% you own outright, then 50% of the income minus expenses and depreciation, because you can do that on that situation, are going to be subject to that tax. So it's not as bad as it sounds, because you do get to take that depreciation and write off that percentage of the expenses, right? 50% in that situation. And then of course, check with your CPA on more of how that works exactly before you make an actual investment, so but with the Solo 401k, you don't have to worry about that, which is pretty cool. And so it makes it a tax efficient solution for leveraged real estate. If you own it outright, it doesn't matter either way. Okay, disallowed investments. With the Solo 401k, the only thing the IRS says that you can't invest in is collectibles. Think cars, artwork, stamps, baseball cards, that sort of thing. And then in addition to that, with the IRA, you actually can't invest in life insurance policies and collectibles. And then the only other thing is, if you're looking to invest in a business, you can't invest in an S corporation, because you have to be a physical person. Now, don't misunderstand me. The S corp absolutely can adopt a Solo 401k plan as the sponsoring business. So we're talking about two different things here. One is what you can invest in, and the other is the adopting business. So two separate things there. So collectibles, life insurance policies, and then the S corp if you're looking to invest in somebody's business. So now we're going to spend a little bit of time on what are disqualified people and prohibited transactions. So think the lineal descents and their spouses. Okay. So first off, even though your wife or your husband is not lineal, the Bible says two shall become one. So you are one. Okay. So you and your spouse are disqualified people. Okay. And then furthermore, the lineal descents, your parents, your grandparents, your son, your daughter, and their spouses, your children and their spouses. Now, and grandchildren, of course. Now, if you go out, brother, sister, cousin, aunt, uncle, friend, whatever, that's okay. They're not disqualified people. And the other caveat to that is entities in which the disqualified person in that lineal descent list we talked about holds a controlling equity or management interest. Okay. So those actually lead to what are called prohibited transactions. I'm not going to read all of these, but I'll leave them on the screen and you can kind of peruse them as I'm talking. But just suffice it to say, you can't invest in a business or lease any property between a plan and disqualified people. So a good example of that is if you own a rental property in, I don't know, let's call it Arizona, and your daughter is going to go to ASU and you want her to live in that rental property. If you own it personally, have at it. But if your retirement account owns it, your daughter cannot take advantage of that property. She cannot benefit from an asset, and you can't either. And everybody in that disqualified party list we talked about cannot benefit from an asset that's owned by your retirement account. Okay. You can't lend any money from the retirement account to a disqualified person. No service or goods can you provide, or any of the people on that list of disqualified people, to the plan, right? So that would be an example of a real estate license. You cannot go represent your retirement account on the purchase of a property. You would have to you'd have to ship that out to somebody else. You'd have to refer it out, but you can't even get a referral fee because then you would be benefiting from that transaction and you can't personally benefit from the transaction. So you're literally just arm's length the whole way. And so those are some of the examples. And then some other examples of the prohibited transaction: you can't use the 401k as a security for a loan, for a personal loan. You also can't guarantee the loan to your 401k, right? Now, don't misunderstand me when I say you can't use the 401k as security for a loan. If you're going to buy a property, let's call it a primary residence, the lender is going to ask you for all your assets, right? Statements and balances. Okay, you can 100% provide the 401k just like you would an employer 401k in your list of assets to the lender to help you look stronger as far as having reserves and such in case, something happens and you can't make the payment anymore. What I'm saying is you can't say, hey, this is security for the loan. This, in other words, if you default on a loan, the lender can take your 401k money because you put it up as security for the loan. That's what I'm talking about, you not being able to do. You can't sell personal assets to the 401k. Something that happens all too frequently is people come to us and they say, and they can be clients, but rarely, usually it's prospective clients we're doing a consultation with, and they say, hey, I'm under contract on a property. I just learned about this solo 401k or self-directed IRA option, and it's going to be a rental property anyway. What I would like to do is I'd like to buy it. Now I'm under contract with my personal name, but I'd like to switch that contract or assign the contract to my retirement account. Now, mind you, in a lot of cases, they don't even have a self-directed retirement account set up. Okay, so they're cart before the horse situation here, but you can't assign the contract. You can't do any personal assets. You can't change from one to the other. The IRS is going to pick up on that, and you can't do that. You have to have the contract from the very beginning, so that original contract that's in your name that you're under contract for on that property would have to be completely voided out, and you would literally have to start over. Again, all earnest money, home inspection fees, everything need to come from that retirement account on property they're going to own. None of your personal money can be involved. So that's a cart before the horse example. So if you're listening to this and you're in that situation or you're doing that, book a call with us as quickly as you can, so we can help, kind of guide you in the right direction on that. And then, of course, you can't perform any services for anything owned by the 401k or for the 401k or self-directed IRA for that matter. All these apply to both of those types of retirement accounts. So a good example of that is if you own a rental property and there's a plumbing issue, you can't go fix the plumbing issue yourself. You need to call a third-party plumber. Arm's length. Again, nobody in that disqualified people list can perform services. It doesn't even matter if you're not getting paid for them or not. You can't do that. And of course, no commingling of funds. Now, don't misunderstand me. If you own a rental property, you can manage it. So the way we like to say it is you can do the white collar work, but you can't do the blue collar work. Okay, so you can manage the property. You just can't go fix anything physically on the property, right? And I've even heard attorneys say that it's okay to go open the front door for people to view the property that are looking to rent it. That is okay. You're not doing any work on the property specifically. You're just opening the door. Again, double check with your tax attorney or CPA to make sure. But I have heard attorneys who know what they're talking about with self-directed retirement accounts say that it's okay to not only manage the property yourself, but also to open the front door for would-be tenants. You just, again, on that situation, you definitely cannot get compensated for any services. So this is just a one screenshot of the difference between the self-directed IRA versus IRA LLC versus solo 401k. So you can take a look at that as I'm finishing up here. If you have any questions, now would be the time to get them ready, put them in the chat, and I will address them here in a moment. And if you do want to get our free ebook, Dimitri, our founder, wrote this, and it says IRA makeover, but it's actually IRA and Solo 401k is covered in here. Just go to that URL in the bottom if you don't already have this, SenseFinancial.com /IRA-makeover, and you can download that free ebook.